This is Rob Barnett, and I'd like to welcome you to today's BI Energy Exchange, where we talk about our research and the latest developments in energy markets. Today, we are delighted to be joined by Salih Yilmaz, and if you're unaware, he's recently relocated to Bloomberg's office in Dubai. So we've now got a voice that you're all familiar with, but from the world's most important energy region. So, Salih, I hope the move has treated you well, and we're going to start off with you. I know we've got an OPEC meeting going on today. Give us your read on what we might hear there and what the read across for oil markets could be.
Sure. Thanks, Rob, and thank you for your kind introduction. I'm actually reading the headlines as we speak because the meeting is ongoing right now, but we know that what they are discussing and are very likely to agree on is a 2 million barrel per day output cut, which is much higher than the higher end of the range that we initially heard at the beginning of this week. So this is obviously a clear shift in their strategy. I mean, we went from discussing increasing output to suddenly, I mean, just last month, just a couple of months ago, we had that increase of, I mean, it was a symbolic amount, but that increase of 100,000 barrels per day, which was undone last month, and then suddenly we're in the situation where the group is saying there are a lot of concerns around recession, there are a lot of fears of what the impact of that would be on oil demand, and they want to preempt that with this output cut. One important thing to say about this is that this headline number of 2 million barrels per day is unlikely to be the amount that's actually the real reduction in supplies. As you all know, and we've discussed many times on this call, many OPEC plus member nations are actually producing way below their targets. So many of them, I mean, this will not really change anything for many OPEC nations, but what we are really just waiting to see in the next half an hour or so is whether we actually hear an additional unilateral cut by probably Saudi Arabia and potentially the UAE as well, which would add to this headline number. So I mean, once again, the last few meetings were very short meetings. This one is going on for a little bit longer, just given, well, first of all, that this is the first in-person meeting in Vienna since the beginning of the pandemic. All the ministers, I believe almost all the ministers are there. But also because this is actually there is actually a change in their strategy. They're not doing what everyone kind of expected them to do all along. We just kind of got the last-minute news that this is going to be an in-person meeting, and then that they might actually announce an output cut, which started with 500,000 barrels per day, but ended up with being as big as 2 million barrels per day. And finally, apologies for the very long answer, but I think at the end of the day, what the group is really trying to do, even though they say they're not targeting prices, they are very much focused on the market's balance. Clearly, the drop in prices that we saw in the last couple of months due to hawkish central banks, recession fears, they want to control that downside and essentially put a floor to oil prices, we believe, at around $90 a barrel for Brent, which they so far looks like they might succeed in doing so.
Very interesting. Let's see how successful they are at hoping to manage the price. You've got some cool research. I definitely want to come back to it, but first I want to swing over to Patricio Alvarez to shift gears and actually talk about the latest with the European gas market and the sabotage on the Nord Stream 1 pipeline. It's been a few weeks since we've gotten the band together, and there have been some really interesting developments there. Patricio, what do you make of the physical disruption? How does it impact the European gas market? And what's your latest read on what winter could look like?
Sure. So, taking on the Nord Stream 1 and 2 pipeline leakages, which are suspected to be acts of sabotage by both Moscow and the West, without any sort of near-term resolution on who's responsible. I think the fact of the matter is that it marks a turning point or a new phase in both the proxy conflict and also the energy crisis by um, basically killing off hopes of a near-term revival of Russian gas flows via Nord Stream 1, which was operational until late August before being suspended indefinitely over a stalemate about the sanctions that were preventing the return of a key turbine needed to operate one of its compressors. I think what this does, it means what it means for the European gas market is that while prices have eased from their recent highs and are still trending downwards at about 160 euros per megawatt at this time. They look set to remain relatively high versus their let's say pre-war levels, which were around the 15 to 20 euro per megawatt mark. So we're still 10 times as more expensive now, but prices look like they could soften further going into well, hopefully going into the winter and into next summer as demand continues to respond versus high prices that we're still seeing. In terms of the winter, we are seeing that this robust or buildup of gas storages in Europe continues to go ahead of plan, and this is what's driving this. I think the sort of easing the pressure on gas prices in the near term. It is important to note that key economies such as Germany are their gas storage is already 93% full as we speak. That's ahead of historical averages and should cover their winter demand by about 50%. So it covers around 50% of their demand. So that sort of reduces, I think, the leverage of any more disruptions for the Russian gas flows that are still flowing via Turk Stream and one of the entry points in Ukraine, which are the only two routes that exist at this time out of the five that we had before the war. So I think that's sort of the gist of it. This all implies that we are able to reduce gas consumption during the winter months by at least the EU Commission's aim of 15%, which, if you look at it, is a significant level of demand destruction during this winter. I think those two sort of factors put together envision a future where we'll be able to survive the winter, but it's just a matter of conserving those inventories so that by winter end, we don't end up in the same place we are now with over depleted storage levels and again sort of competing in the global LNG market to refill them next year.
Now, I know the typical consumer is not paying wholesale prices, but you mentioned the idea that the gas price was in the neighborhood of 10x versus what it was prior to the crisis. So how is this going to play out? Are we looking at a significant recession? And I want to come back to Salih because I know he's got a note out on a recession. But is a European recession inevitable at this point?
I think that's perhaps a little bit above my pay grade in terms of being an economist, but I think there's really no release valve. It's either you look at I think the size of the demand destruction that you have to sort of go through enable to meet that shortfall in supply. So 15% is massive. I think that would be a reduction on either the PMI, so with the production manufacturer index in Germany and other economies in Europe. So you have that demand side response, which is very strong. And at the other side, if you choose to sort of bail out both utilities and customers by basically producing debt to finance those tariff caps or tariff freezes to protect customers, you would still be creating a huge imbalance, I think, or widening the deficit, which again would lead, I think, to a recession as well. So it's very hard to see a path towards a soft landing out of this.
Okay, very interesting. I'm caught by this idea that you discussed with a 15% demand destruction potential. Maybe it's more than that, maybe less, depending on other fuels and other things. But Salih, you've got a note looking at the oil side of the equation. I think 15% is a lot on the gas side here in Europe, but how much global oil demand could get hit during a recession, and kind of how do you read the tea leaves on what it could mean for the oil market?
I mean, for the oil market, it could be just a couple of percentage points, and that could actually be enough to flip the market back into a surplus. And we've done some work on that, but obviously something that we've discussed on this call before. Not every recession is the same, and we really don't know what the impact of this particular recession, if we do have one globally, the impact would be on oil demand. But we actually have a pretty cool function, I think, on the terminal called TSIG, which is trading signals, and we've tried to do some analysis using that to see what happened to demand when there was a recession, and what happened to oil prices when there was a recession in the US, which is what we have a ticker for. And the impact on demand can change a lot. So not in every recession we had a huge hit to demand. I mean, the one back in 2020 during the pandemic, that was a big one. Back in 2008, the GFC, that was quite big. In terms of oil prices, we did a separate analysis on that using TSIG. And yes, I mean, as you would expect, oil prices do not like recessions. And on average, the 12 months following each US recession, on average, oil prices actually went down by about 30%. So I think this is why, and as you know, the last couple of months, something that we've been talking about, the recession fears, that recession angst have been dominating the oil market, and that's the reason why we went from more than $110, more than $120 a barrel for Brent to below $90 a barrel until just very recently, until a couple of days ago. And again, going back to our earlier discussion about the OPEC meeting and why they might be doing what they're doing today, is we tried to run TSIG again on every time OPEC actually cut its production by 3%, then what was the oil price reaction? And on average, oil price went up by about 12% in the 12 months following an OPEC output cut in that size. So again, obviously there are so many moving parts. Recession has been, and the recession fears have been dominating the market, and against that, we have OPEC intervening again quite aggressively. So a lot of unknowns. Recession is a very big one, and even within that recession, we just don't know how big of a recession that we'll see, where we'll see a recession, and what the impact on oil demand will be exactly.
Now, 3% is not as large as the number that's being discussed at the OPEC meeting today, right? 2 million barrels per day is more than 3% of their current production.
I mean, we did at least 3% or more, and obviously the history we have is for OPEC only, not OPEC plus. And when you do 2 out of the full OPEC plus, it's still, I mean, I think it's even closer to 4%. But yeah, basically we looked at every time they cut their output by 3% or more.
So Saudi Aramco CEO Ayman Nasser was speaking at a conference just the other day. He talked about some of these issues, and there were a couple of things that caught me about what he said that I found pretty interesting. One is that, even if you set aside a recession, his view is that the market looks undersupplied for years, and that you can't have supply respond quickly enough to where the sort of general demand, even accounting for a recession's at. What do you make of that? Do you think that we need more supply, and kind of what kind of price signal do you think we need to drive it?
Yeah, I mean, I generally agree because when you look at Aramco, when you look at ADNOC in this region and how they are trying to increase their maximum sustainable production capacity by about 1 million barrels per day each, and they are talking about timelines of between now and 2025, 2027, 2028. So I think that just shows that even these countries, even these companies that are fully committed to earmark enough spending to increase their capacity, it just takes a very long time. And I think the argument goes that it's not just today's story. I think arguably since 2015, we've had underinvestment in this sector for various reasons. And I mean, let alone the last 7 years. Right now, we have oil majors, which are responsible for more than 30% of production globally. We see them also not really focused on increasing capacity. Actually, they are saying that actually we might have seen our peak production levels right now. I mean, our spending kind of breakdown is going to look a lot different. Obviously, we are still spending in our legacy oil and gas businesses to make sure we produce as much as we do right now, probably going to decline. But they are not talking about investing so that they produce more because a bigger and bigger chunk of their capital spending is now going to low carbon solutions. So again, a big assumption in what Amin Nasser, CEO of Aramco, said is we have demand. I believe he said we have demand growing all the way up to 2050. I mean, this obviously is at this point a controversial take. But I mean, even if you agree that it grows in the next 5 to 10 years, I think that's still a long enough time period where we might continue to suffer from the years of underinvestment that we had if we again see demand growing beyond obviously the China zero COVID policy and lockdowns that we're seeing there, which really is an overhang on demand growth at the moment. But once that's over, and if we do get back onto the growth pattern that we've seen in the last decade, I generally do agree with him that we may struggle. And by the way, I think IEA also said the same thing about the next couple of years where supply may actually continue to struggle to keep up with demand. But once again, a big assumption here is that we have demand continuing to grow.
I love that you brought up 2050. I was going to ask you about that. And Patricio, hang on. We're going to come to you in a second because I think this kind of can tie into some recent work that you've done that I found interesting. But Salih, just real quickly on the idea of oil demand growing steadily through 2050, I believe he either said or implied that the world was basically not ready for the energy transition, or that we're not really in that frame yet. You know, I know you talked more, maybe it's 2030, but what do you make of the concept of the energy transition? And I know you mentioned that the European oil majors are already sort of diversifying their capex, doing lots of interesting things, but kind of how do you roll it all up at the industry-wide level? You know, do you think that the sort of OPEC plus in private industry that's meeting the world's global energy needs right now, you know, are they ready for a transition? Are they thinking about it? And what does it even look like?
I think in terms of globally, the writing is on the wall, right? I mean, energy transition is happening, it's accelerating. Arguably, I mean, with the situation that we have in Europe right now, we have been arguing that this actually accelerates energy transition. And on top of that, I mean, for oil demand specifically, we have just accelerating adoption of EVs. We have the promise of more fuel efficiencies that goes into the big chunk of that oil demand for road transport. And I mean, I do get the argument that a big chunk of the oil demand that we have at the moment is very sticky, is very difficult to replace it structurally. But I think we are at a turning point now where there are many factors at play that will continue to eat off from the oil demand. And again, oil demand peaking in 5 years, 10 years, whatever that might be, doesn't necessarily mean that it peaks and just falls off a cliff. It's possible that it peaks and then kind of remains there for a little while, because big argument, a very popular argument is that yes, there are all these things that are reducing oil demand, but at the same time we have population growth, we have that increased, we have that marginal demand from increased petchem consumption. So maybe those cancel each other out, and we have oil demand at whatever point for a little while, not increasing but not decreasing. But I think energy transition at this point is hard to ignore, and for these companies, again, something that we talked about on this call before as well is that oil demand might go down, but that may not necessarily be a bad thing for them, right? Because these are extremely low operational cost producers. So demand may go down, and then we need less supply, and then other higher cost supply may come off, and then these regions and these companies may actually end up with higher market share. And depending on the pace at which supply is going down and then demand is going down, this is in the next 10, 15, 20 years, depending on the pace at which those go down and potential dislocations, we may end up in a place where we have much less demand, but these companies have much higher market share. And because we are at the point where demand is still higher than supply, albeit lower than previous levels, we still have high pricing environment. So this does not necessarily mean just completely bad news for them, but I think at the same time, it's very important for them to kind of enjoy these high pricing environments, but make sure that they diversify away from fossil fuels, because as I said earlier on, the writing is on the wall. We don't know if it's 2040, 2050, 2060. I think it's becoming more and more clear that these economies and these companies have to eventually diversify away from fossil fuels to lower their dependence on them.
Okay, very interesting. Hang on, we're going to come back to you. I got one more piece of research that you've done that I think is neat that we want to highlight here. But first, I want to circle back around. And by the way, if you haven't read our colleague Colin McCaricature's piece on a hyperdrive column on Bloomberg, I highly encourage you to check it out. You know, he works for Bloomberg NEF. They are quite bullish on the path for electric vehicles, and he shows that even with a very bullish scenario, which they have for EVs, he basically shows that the electric grid can handle it. So I know there's sort of this argument circulating out there that the electric grid is not ready for the big wave of EVs. He does put some water on that argument and does it with some nice data sets. So take a look at that piece, and we'll make sure to get him back on before too long to share his thoughts. But Patricio, on the idea of energy transition, your companies, the utilities, are front and center for the transition in many ways. And we had an interesting piece of M&A news happen with your company, RWE. So tell us what they're up to, what assets are they buying, and how does it fit with their overall transition strategy?
Sure. So RWE is one of the largest coal-fired producers of electricity in Europe, but coincidentally, it's also one of the fastest growing renewable developers in Europe. So this is very interesting for them. So RWE has that sort of dichotomy between being the dirtiest producer and also sort of managing the transition in an accelerated way, both in Germany, its home market, and it also has exposure in the UK and the US. So now they've gone and purchased, they plan to purchase Con Edison's renewable unit in the US. That would make them one of the largest solar operators in the US. So that would definitely double RWE's presence in the US, and I think it makes a strategic sense, both from a global diversification standpoint, pivoting away from Europe, which remains, has a little bit of an uncertain outlook in the next few years just because of the energy crisis now. So pivoting away into the US makes sense, both from a diversification standpoint, but also because of recent policy support in the U.S. with the Inflation Reduction Act, which is extending significantly extending the tax credits for both investment and
We might have lost.
Sorry, I'm back. I'm back.
Oh, here you
Sorry
are.
about that. Okay, so I think where was I? RWE's pivot into the U.S. or doubling up on the U.S. makes a lot of sense because of the Inflation Reduction Act and the sort of the supportive read across it has for developers such as RWE. But I will caveat that by saying that this will take a little bit of time. So it's more like preliminary positioning because the IRA will come into effect and sort of I think make landfall or impact on actual growth in the next few years. It's not something that will happen overnight, but RWE is definitely gearing up.
All right. If your microphone can bear it, I've got one more question for you. And since you're standing over my shoulder, I know you can hear me. Now, we've got one other topic. You were talking about the elevated gas prices, and I want to gauge you on how quickly do you think they're going to motivate the energy transition in Europe? And the reason I ask is because they're buying assets in the US, and you would think renewables look very attractive based on the run up in gas prices, but I know there's also a whole lot of policy stuff with capping prices and doing all these sort of market interventions. So can you kind of give us a sort of summary of how to think about what's going on with all those policy efforts to shield the consumer from the price run up?
Absolutely. So the European Commission has proposed three main measures. So one of them is to reduce power demand during peak times, where gas tends to have an outsized influence in setting the wholesale power prices. So that makes complete sense to us, and it's not a binding. It is a binding target, but it's left to each member state to decide how to do it, either by financial incentives or capacity auctions. But that's still up in the air. But that's main focus is to reduce power demand. Second is to apply some sort of cap or windfall levy on the revenues of power producers and suppliers, and to utilize those funds to alleviate the energy, the end consumers' energy bills via rebates and so forth. In terms of what's pending or what we will see by the end of the week is sort of the refining the final sort of measures on what is to come.
All right, Patricio.
Yeah, I keep cutting out. Sorry.
We'll come back to you next week. We'll get you a new headset. We'll make sure it's all working. It's all good. Thank you for your comments. Okay, Salih, I want to come back to you on one topic. You've kind of incorporated it into some of your answers already, but you put out a piece since we've last spoken that leverages a new piece of analytics that you've done. So you've got this oil fair value model that you've created. It's really cool. For anyone who hasn't seen it, either look up Salih via his bio or hit one of our dashboards to read his note on this. But Salih, you've got some really interesting scenarios you've run. Tell us about the fair value model. How's it work, and what's it telling you about where the price may be headed over the near term?
Sure. So, I mean, this was an experiment, if you will, that we've done with our data science team here. And what we wanted to do is to find a good regression fit, focusing on the last 12 years on what drives oil price. And it has been a big trial and error. Obviously, we had a lot of things that we thought might be important for oil price. Some of them were, some of them weren't. But some of the very interesting observations that I had from it was that like policy factors are actually very important, almost more important than some of the market fundamentals that we actually spend a lot of time on. I mean, things like money supply, things like interest rates, inflation expectations, and obviously the dollar actually play a big role in driving oil prices. And I mean, the relationship between dollar and the oil price recently, especially, has been quite fascinating and quite significant. But obviously, when you look at this historically, this is a very unstable relationship, and we're aware of that. And on top of that, I mean, some things that we really thought would be very important, such as the supply-demand balance, wasn't really that important, it seems. I mean, we found that inventories and what's happening with inventories is very important, and arguably the supply-demand balance and what's going on there actually trickles down to inventories. And refining margins, obviously, I mean, as expected, seems to be quite important. And we essentially converted this into a fair value model just to see what the model thinks that the value should be at the moment. And if I may take a mini victory lap here, the model actually said it would be $90 a barrel a couple of weeks ago when oil prices were 85. And tada, today they're at around $90 a barrel. So the model seems to be working. But I mean, obviously, this is not perfect. But I think it's just been a very interesting exercise to see what's important and what's not. And we've done some scenarios with it. I mean, our steady scenario, which keeps everything steady, all these variables that I mentioned that we found are important. When we keep them steady is where the fair value is. And then when we keep them steady for the next few months, we actually see the fair value inching up closer to $100 a barrel. Looking at the current state and running some scenarios on what a faster growth would look like, we see oil prices already at more than $100 a barrel. If all these variables are in favor of a more bullish outlook. And on the other side, on the flip side, our slow growth scenario sees oil prices as low as $70 a barrel if all those variables are a lot more bearish. So this, unfortunately, I mean, if you have any questions, do have a look at the note that we put out. If you have any questions, please reach out to me. Unfortunately, this is not a tool that we are making available, but we are working on it, and hopefully this will be a tool that we make available on the terminal pretty soon. But yeah, that's it for me.
Cool. And I've had several people IB me asking me about your note, Salih. So we are all available on IB. Shoot us, ask us your follow-up questions. We're happy to share the note. We're happy to talk more about our research should you have questions. And remember to check out our dashboard. So we've got the BI OPEC dashboard where you can go and get Salih's latest thinking on the oil market. You've got the BI EGen dashboard for where you can get all kinds of great stuff on the European power and gas markets. You've got the BI solar, BI wind for what's going on with the energy transition. So we've got you covered.